All right. Today is Sunday, November 26th, and this is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight. Hope everybody had a great Thanksgiving holiday. Of course, this is the Thanksgiving that survived the Ozempic massacre. Just a few weeks ago, they crashed a bunch of good stocks because, Ozempic is going to cause people to eat less or not need surgery anymore. And all I got to say about that, look, this Thanksgiving you probably ate some stuffings. When you're done, you got another round of stuffings. And then the day after, you got some leftover stuffings. And today you got a little more and now you're feeling funny. You have to run to the pharmacy, get some Pepto-Bismol, and tomorrow you're going to call sick for work. And that's the proof, ladies and gentlemen, here that the Ozempic mania is bullshit. Good news is, in this channel, we did not really believe the Ozempic massacre, and we thought that it could be an opportunity to buy. And since we added, for example, McDonald's, they said crash the stock because nobody's going to buy Big Macs anymore. Well, it's an addiction, folks. Then, of course, this week, another victim of the Ozempic massacre, Medtronic, got vindicated because the assumption was we got to crash the stock because nobody's going to have heart surgery anymore. Ozempic is going to fix it all. Well, that was another buying opportunity. Then we got Mondelez. Look at this. Since it got massacred by the Ozempic mania because nobody's going to eat Oreos anymore. I mean, the whole country was built on Oreos. Might as well carve an Oreo cookie in Mount Rushmore. And that was a buying opportunity, and the stock did a nice recovery since then. But a lot of you, the managers and the Wall Streeters, they're all fixated on the 7 stocks, but especially NVDA. You gotta buy NVDA because that's where the magic in. And it hasn't been happening, folks. The stock been stuck for months now. And this week was not a good indicator for NVIDIA. So let's talk about NVIDIA a little more and the AI mania. We begin with perhaps one of the most bizarre business stories, not just this year, but ever. You know, the CEO of OpenAI, the poster boy of the AI mania, was suddenly fired all of a sudden. And it was strange. Why would you get rid of him Friday, right before the close of the stock market? Speculations ran haywire, but nobody knew what was behind it. What caused the board to fire the CEO? Then, of course, before the market opened, Monday, CEO of Microsoft, Nadella, comes out and says, hey, we hired the guy. Please stop selling the stock. And then midweek, we got the news that maybe Sam Altman is going to be back at OpenAI. And now we hear some details on perhaps why he got sacked to begin with. And the board thought that the Project Q, which is a project under OpenAI, could threaten humanity, aka Skynet. And even Elon Musk came over the weekend and said something scared the chief scientist at OpenAI. And maybe that's the reason we saw Sam Altman getting sacked. Which now brings the question, is it really Skynet? Is what we're seeing right now the creation of something ominous and could threaten humanity and maybe cause the loss of a lot of jobs and cause chaos worldwide and only serve the elite? Well, it's certainly shaping to be that way when you have OpenAI now having Larry Summers, of all people, in the board of OpenAI. Yeah, it doesn't look good. But folks, we have this I would call them the QE generation, who get excited about everything. Oh, this is the future, brah. Not knowing, of course, that they're cheering for their own demise. They cheered for QE and stock market bubbles, and now they cannot afford homes anymore. And now they're cheering on AI, and then AI will take their jobs. Whoops. But that's the genius of the QE generation. And ladies, I got some bad news for you. It's over. I mean, you're not needed anymore. We were questioning, what is a woman anyways? And now you're getting replaced. You know, the heydays of going on Instagram, sharing pictures of your booty, and then luring the fans to OnlyFans and charging $25 a pop and retire at 26. Yeah, those days are over now. Because we got AI models, and they make more money now. And they're flawless. You can't even compete with them. They don't even age. How the hell are you going to compete with that? And the QE generation, by the way, they don't even like women to begin with. They want to bang AI. So you're done, ladies. I'm sorry. It's over. Rest in peace. And that leads us to NVIDIA, since we're talking about rest in peace. Here's the weekly chart of NVDA NVIDIA, the poster boy of the bubble that we have right now. You know, during the last quarter, not the report that we got this week, but the one before that, NVIDIA gave us a massive upgrade in the revenue guidance. And the expectations were, okay, NVIDIA is going to pop even higher because of this increase in revenue. On the contrary, the stock got sold instead. And then we got a little more excitement. Oh, maybe this is going to be it. Maybe this quarter they're going to issue a massive revenue increase. And we go over 500, 600, 1,000. Well, we got another massive increase in revenue guidance. They have to beat the expectations now because the analysts, they give them a revenue guidance. NVIDIA has to go above. Otherwise, the whole thing is going to blow up, which is a dangerous game, by the way, because the bar gets higher and higher and higher. And at some point, you're going to fail. But the fact that the stock failed to make new highs after 2 reports with massive increase in revenue guidance, what would it take for NVIDIA to move higher from this point here? AI porn? Because there's nothing left. You can pump the stock all you want, it's not moving higher. It's not crashing either because the story's not reversed 180. Here's the problem though, and here's the source of concern that could reverse the stock 180, and of course, we're not going to have to wait till the next report because when the company, any company that wants to downgrade a previously issued guidance, they're going to do it before the report comes out. And here's the problem with the next report coming from NVIDIA. It's called China. And of course, the CFO came out and said we expect our sales to these destinations, meaning China, will decline significantly in the fourth quarter of fiscal 24, meaning the next quarter. Though we believe that the decline will be more than offset by strong growth in other regions. What other regions? Uranus? Who's going to replace the massive revenue coming out of China? I get it, the shady companies from the Cayman Island and the Isle of Man, buying tens of millions of dollars worth of NVIDIA chips to sell them in the black market, to sell them to China, to Saudi Arabia, and to other countries. Lots of shady stuff. But how long will that last before they get caught? And on Thursday night, we got the news that NVIDIA is delaying the launch of new China-focused AI chip. Remember what they said? They said, okay, we can't sell the chips to China. So we're going to find a loophole and tweak the chips here and there, and everything is going to be fine. I told you, forget it. The government doesn't want to sell these chips or any version of these chips, any modification of these chips to China. They see it as a national security issue. The question now becomes, okay, if China revenue is about to go down and there is no replacement because we're seeing economic weakness here, so the companies that are spending like a drunken sailor on NVIDIA chips will likely reduce spending as we see more economic weakness. And oh, by the way, other suppliers, other competitors, be it AMD, be it Microsoft, producing the chips in-house, which by the way will reduce the pricing power, the $40K a pop that NVIDIA is charging right now. When you put it all together, now even if you happen to be the bull of all bulls on NVIDIA, you're beginning to get concerned that maybe the story has stopped here. And this is why we see that it's really hard for the stock to move higher from this point on. And we all have to keep in mind that NVIDIA and the AI mania was the reason why we've seen the stock market rallying this year. Because when you open the hood and you look at the other 494 stocks in the S&P 500, most of them are down. Absent of these AI mania stocks, the stock market should have been down this year. So when you take the crown jewel of this story and you begin to poke holes in the thesis, what's going to hold the stock market if these names go down? And this kind of concern is not going to stop from this point on. It is just beginning. Another concern, folks, and this leads us to the next story that we have for you tonight, oil. Saudi Arabia is now planning a massive move that could be coming this week. That it could either cause oil prices to spike higher or to crash down as we've seen back in 2020. What are we talking about here? We're talking about the delay of the OPEC meeting that was supposed to be held this week. And immediately after we got the news, oil prices went down. The headline here says 1%, but they went down by more than 4%. There was a recovery midday, and we called it accurately in our Discord that you gotta buy the dip in USO for that particular day just because the delay of the meeting caused an overreaction. But we're not sure about the outcome yet. It could be that supplies will be cut and prices will go higher again. Because the dilemma here is Saudi Arabia is saying, look, we have an oversupply problem in the market right now. And we have a lot of speculations that we have weakening demand coming in. And of course, oil traders, the moment they get any recessionary news, and we got plenty of that in the last couple of weeks, they begin shorting oil aggressively. And with that comes dumping of oil and prices go down. And for the Saudis right now, the only thing that they got is to cut supplies even more. The only problem is, even if they cut supplies, doesn't matter if it's not a collaborative and inclusive oil supply cut by the majority of members in OPEC+. But we know that the problem is every time Saudi cuts supplies, other countries don't obligate with their supply cuts promises, and they keep supply at a higher rate or even increase it. Or we see countries outside of OPEC Plus increasing supply because prices go higher once Saudi cuts, somebody sees the advantage, such as Brazil, such as US producers, and they take advantage of that. Supply goes higher, and whatever pump we got in oil prices was only transitory. And Saudi now has the nuclear weapon. What would that weapon be? Well, we got a taste of that in 2020 when Saudi said, okay, you guys not going to obligate with your supply cuts. Well, watch this. We're going to increase supply to the max, and we're going to crash oil prices for everybody. And this is what we got in 2020 during the oil wars between Saudi and Russia. And the reason behind the delay of the meeting, that Saudi was getting really close to that nuclear option. So instead, we saw the meeting delayed, and now we have talks about, okay, maybe we're going to have a unanimous supply cut from OPEC. And if that is the case, then we could see oil prices moving higher again. And a surprise oil cut, specifically if it is large and unanimous, it could flip the futures market in oil into backwardation. Now, what does that mean? Remember, we have backwardation, we have contango. Backwardation is when the current future price is lower than future contracts. So the price for the current contract is lower than next month contract, so on and so forth. We call that backwardation. And usually it's a good sign that prices will increase and investors in these futures will see an appreciation in value. Not all the time, and seasoned futures traders, they know what I'm talking about here. Then, of course, we have contango when the current price is higher than future prices, and that's probably not a good sign because maybe the inflation in prices is coming from other factors besides the spot price of the commodity. And once that's gone, prices go down. Backwardation, it's the opposite story. We can see here why we're having differences within OPEC. The Saudis cut and their 24 target will be lower than the production of the month of October, but other countries will increase their supplies in 24. They did not like the cuts to begin with. We're talking about UAE, of course. And the compromise was, okay, go with the cuts right now, and in 24, you're allowed to increase your production again. Problem is, Saudi now wants more cuts. Otherwise, they're going to use the nuclear option. Because right now, the risk is for oversupply, believe it or not, since we're seeing weakening in the macro environment, not just in this country, but globally. So we see the prompt spread in crude oil futures flipping to negative, indicating a recession coming. And the only remedy that OPEC Plus sees is you gotta cut the supply dramatically. It's not just because we have weakening in the macro environment and the demand outlook. We also have inventories and supplies here in the US increasing again. And that will add more downward pressure on oil prices. Now we go back of why is the move we're about to see in oil prices would be significant, that we will see a either massive pop or a big drop. We know why we're going to have a big drop if Saudi uses the nuclear option. But why would we see a big drop if we have a big enough of a supply cut? The answer to that is we have extreme bearish positioning here in oil. Folks are buying a lot of puts, shorting oil as if they were anticipating a recession, and correctly so. So the element of surprise here is inducing a massive short squeeze in oil futures, because a lot of these traders will have to unwind their bearish positioning against oil rapidly and suddenly, and that causes a big spike. And of course, I thought it was a lost opportunity that Saudi and other countries did not do an embargo because of the war in the Middle East, because they could have hit two birds with one stone. Asserting their leadership position in the Middle East, the Arab and Islamic world would have been one, and the second one would have been inducing perhaps one of the biggest short squeezes that we have ever seen in the oil market. But maybe again, Saudi Arabia is just holding that card for another day. And the risk here is, if we see a sudden spike in oil prices, combined with the weakness that we see in the economy indicating a recession, which we're going to talk about all of that data in a minute here, that we're going to have a stagflation crisis, just like we've seen back in the late 70s. And that's going to force the Fed to be as hawkish as possible, if it's not by increasing rates higher, by holding rates higher, which will cause more and more damage to the underlying economy. And oh, by the way, in another subject here, since we're talking about oil in Saudi Arabia, how about the news that we got that Saudi and China signed a $7 billion currency swap agreement, which is yet another effort toward de-dollarization. We will see more of that because a lot of oil-producing countries will say, wait a minute here, it's because of what the Fed is doing, because of the manipulation of the dollar, we see oil prices getting crushed. And if we de-dollarize, we can have more control over the price of oil. And by the way, the push to de-dollarization from the dollar toward the yuan is gaining a lot of momentum. We talked about BRICS before. Now we look at the outstanding balance of the yuan in foreign central banks. That's increasing while we see the outstanding balance of the US dollar going down. This is a significant change, folks, that we haven't seen before, and it will have massive ramifications. But that is a subject for another video. What we have to talk about right now, since we talked about the price of oil and the risk of recession and maybe stagflation if we see a pop in oil prices, well, let's talk about the recessionary environment that we see storming the economy right now. We talked about a bunch of that in the video produced last weekend. Do you want to see it to believe it? Do you want to wait for the recession to actually happen and then realize, whoops, I got to do something here because last time around that was too late. Waiting for the recession to happen and then taking action was too late. And the warning signs were plenty. Since the year of 2006, they were heading for a recession. The warning signs that we have in this economy that we're heading into a recession track back since the year 22. And we get more and more of that, intensely so, in the fourth quarter of this year. The problem is, once again, folks, that the recessionary signs that we see in the economy right now are combined with a higher inflation environment that is much, much stronger than the last episode during the GFC. We talked about core inflation being at 4%, which is double the Fed's target. That's nothing to be excited about. That's nothing close to mission accomplished. And this week, we got even more bad news. The headline reads, U.S. consumer year-ahead inflation expectations rise further, the highest since 2011. And you can see the trend right here. The trend is accelerating and gaining momentum. Consumers are now expecting more inflation in the long run than not. So a lot of you geniuses will say, Maverick, you're wrong. Inflation is dead. Genius. The conditions for inflation to go higher are still here, and they are irreversible. Deglobalization, nationalism, lack of resources, the push for green energy, all of these are inflationary in nature. They're not going to be reversed because we have a recession. They might dip, they might disappear for a little bit, but they will come back again. And this is why this episode is perhaps the most dangerous that we have ever seen, because you have higher interest rate environment causing recession in the economy combined with a really stubborn inflation. You cannot guarantee any dip to last here in inflation. It keeps coming back because right now inflation is embedded in the global economy. Take the story that we just talked about right now, oil. Do you really think that oil-producing countries, such as Saudi, for example, will accept prices to be down in the 60s or even 70s? Absolutely no way. And they will do whatever they can, along with other oil-producing countries, to keep those prices as high as possible, recession or no recession, even if it takes aggressive cuts in the supply of crude. That's inflationary. That's not going to be reversed anytime soon. And actually, the recession, global recession that is, will prompt these countries to be even more aggressive in cutting supplies and keeping these prices as high as possible. And that's the risk of stagflation, and it's not going anywhere from here. It just keeps amplifying. The Federal Reserve, they said, the Fed is cutting rates pretty soon. It's over. You got to buy stocks. Everything is going to be fine. Problem is the Fed says, no, we're going to stay as high as possible for as long as possible here. The job is not done. And Powell will come out this week. And the assumption is he has to talk to the market. Stop being too excited and overreact to these kind of news. You're gonna be wrong. You've been proven wrong multiple times before. 6 out of 6 times when the market anticipated a pivot by the Fed, they were wrong. This is the 7th time. And the pivot this time is toward a cut. Not gonna happen until we see a disaster, until we see the unemployment rate rising above 4.5%. And even if that happens, who's to say that inflation will be down when we talked about all of the factors that we just talked about, oil, etc. Very, very dangerous environment, folks. And as rates stay as high as possible for as long as possible, look at what's going on in lenders and banks. When we talk about the systemic risk here, the losses in held-till-maturity assets and even available for sale are staggering. And if you keep that pressure for as long as possible, something is going to blow up here. And this is even a bigger pressure than we've ever seen in the GFC episode. The market right now is making a major mistake. The market right now is assuming that bond yields will go down because we have some weaker economic data and the Fed will cut rates to fix all of that, and we will have the Goldilocks/the soft landing scenario. One thing that you don't understand is the Fed has control over the short end of the yield curve even if they cut rates. That's where the controls stop. And we just told you that cutting rates is not really in the bag even with economic weakness because we have other factors that will keep inflation higher. But even if they do that, there is no guarantee that the longer end of the yield curve will respond, and it could stay as high as possible because the supply issues and the deficit that led to higher bond yields on the 10 all the way to the 30, that's not resolved yet. And again, we could see economic weakness, but higher bond yields regardless. This is the most dangerous combination. We haven't seen that before. This week, we got more warnings about the weakening of the economic conditions in the economy and the consumer, which will lead to higher unemployment coming soon. Last week, we talked about Target, Home Depot, Walmart, all warning of weaker consumer. This week, we got Best Buy, warning that demand is weakening as we head to the holiday season. Even Black Friday deals. They're doing all of these flashy displays to lure you into the stores because they know that the shoppers are getting really weak. And as Walmart CEO says, the consumer has the tendency now to not spend and instead wait for deals to come, be it Black Friday or Cyber Monday. And then they do their shopping at that particular day and then they cut and they're done. And that's yet another evidence of the weakening of the consumer that we see in the economy right now. So I would not be surprised to see that Black Friday numbers are coming out hot and they could push bond yields higher in a recovery, which will push stocks down. But again, that's going to be a transitory bump in retail sales and spending because the consumer will go back to retreat after that. Why? Because 60% of Americans are living paycheck to paycheck. So they have to wait for deals and don't shop between these deal periods. That's recessionary. Gee, why is that happening? When we look at the delinquencies for credit cards, they're moving higher. We talked about credit card debt reaching over $1 trillion, a historic high. The consumer is getting weaker, their spending reserves are not enough, they're swapping the credit cards, now the debt is accumulating, and some folks are beginning to fall behind. Another sign, classic warning sign, that we're heading into a recession that could be combined with higher inflation, and hence we have a really, really brutal stagflation environment. Even the hottest sector in the economy, folks, is beginning to fall apart, as we talked about in video in details last Wednesday. We got the data that the share of U.S. home sellers dropping prices is at record high. Gee, why would they drop prices right now? Mortgage rates are high. That's preventing customers and buyers from buying homes. The sellers are now getting desperate. They're sitting on all of these homes and saying, okay, I guess we have to drop prices right now because we're not seeing any sign of demand. We're becoming really worried that the economy might get weaker and we might miss the opportunity of selling the home at a desirable price. We might miss it if the economy goes down crashing really rapidly. That kind of thinking will be contagious. A lot of other folks would say, okay, let's cut prices now to attract buyers because we're not seeing them coming here. Problem is, what if rates stick higher and the buyers need lower prices to compensate for the increase of the mortgage rate? Folks, when the housing market becomes really weak and begins to fall apart, that's another classic sign that we're just around the corner here. We'll look at the year-on-year growth in home sales by investors. Those are crashing just like we've seen back during the GFC. Why? Because it doesn't make sense at all. You're going to overpay for these homes. Whether you do Airbnb or rent these homes, good luck. In this weakening environment in the economy, you're not going to flip your investment into positive. And sooner than later, those who bought homes during 21 and 22 and they did the Airbnb thing or they rented the house, they're now going to realize that soon enough we'll be sitting on negative equity and they will begin to panic and dump these homes. Because as the economy weakens, your tenant will not be able to pay the insane rent that you're charging right now. You better get ahead of the game, get rid of the house right now before you get into that situation where you're sitting at negative equity. And oh, by the way, your tenant lost their jobs, they can't pay anymore, and you can't find a replacement. You have to reduce your rent down. All of this thinking will crash the housing market, folks. And if that was not enough, we got another classic recession signal here from Apple. The headline reads, Apple sales declined for the fourth straight quarter, marking the largest slowdown since the year 2001. We're talking about the most important company, not just in the economy, but the stock market. We're pumping the valuations while the fundamentals of the company is actually collapsing. Does that make sense at all? Does that seem as sustainable? Of course not. But right now, it's all about positioning. It's the chase of positioning. We don't care what the stock is. We don't care about the fundamentals. We're betting on these magnificent 7 stocks as if they were horses. Just keep piling in and push the valuation as high as you can. So long as there is a buyer, another fool who's going to buy from me at a higher price, sure. What happens if that game ends, though? What would be the 180? What would cause that? Historically speaking, it comes out of the blue. And then it becomes too late to get out because the reversal happens rapidly. We've seen it happen time and time again, folks. And now we see bond traders boosting U.S. recession bets as the economy stumbles. We'll look at the 10-year yield premium. Now it's going back to negative, meaning that the recession risk is higher than the inflation/the supply risk of treasury bonds. And that brings us to the stock market. What you see right now is from New Edge Wealth. What's her name? Cameron. She's always on CNBC. Anyways, S&P in this rebound higher, defying the correlation with the U.S. surprise index, meaning the surprise is the economy is actually surprising to the downside, indicating recession. Market goes the other way. Well, if this market rebound was based on mechanics and positioning and short covering and not really any fundamentals, this is not going to be sustainable here, folks. And sooner than later, the market will follow through with the surprise index. And we anticipate, by the way, a rebound in the 10-year yield and a rebound in the dollar this coming week. So let's talk about the strategy, folks. Last week we had a strategy which is you got to stick to the 2-to-1 upside exposure. Your upside exposure should be in the catch-up trade, which is related to the dollar and bond yields. No, we lump Tesla in that, not in the chase trade. You actually got to have your one downside exposure in the chase trade, meaning the big caps, the AI mania. And we went with the Apple puts. We'll talk about that in a minute. But notice that in any classic mechanical rally, just like we got, it begins with short covering, then the quant funds hop in, then we have the market maker due to the options expiration phenomenon also buying. Then comes the capitulation by the managers. They have to buy. It's just positioning. They have to buy. Whether they believe it or not, they gotta buy. But the last one to the chase, the retail mom and pops, usually marks the tops. And now, finally, we see the retail mom and pops loading up on stacks. Black Friday sales, baby. Too late. Why? We talked about this in the morning brief on Discord on Black Friday before the market opened. I showed you the contract in the SPY that had high open interest at the 460 put strike, which expired in the money, by the way. What does that mean? Somebody's placing a top here in the market. Somebody's saying, I want to short at 460 because forget it. Whatever this squeeze lead us to, it's not going to lead us above 460. If I short right now, I'm going to be rewarded. And the other phenomenon is, if we look at the calls side, for 3 weeks, the market maker has been rewarding calls, punishing puts. This is the first time in 3 weeks where the market maker rewards puts and punishes calls. The highest contract with open interest, the 456 contract, expired out of the money. We haven't seen that before in 3 weeks. So this is yet another sign that things are changing here. We're getting a little toppy, and bond yields and the dollar will probably stage a comeback. Even Art Cashin says that investors should be careful amid market rebound, watching a key level in the 10-year yield. What is he talking about? Here it is. I think that the Fed officials don't necessarily want to play Grinch, but they're being bothered by the fact that the market is getting more optimistic. Cashin warning that the recent upbeat sentiment may be stretching too far. I would be a little careful here. I would watch that yield on the 10-year. We may get another retest of the higher level in yields, while all the Fed jabber is going on. If the yield in the 10-year note begins to move above 4.55%, Cashin said that could put mild pressure, quote unquote, on the equities market. Now, I do agree with Cashin that if we see a rebound, and we will see a rebound in the 10-year yield, it will cause a pullback in equities, the much awaited pullback. But it's only going to morph into a sell-off if we threaten retesting 5% in the 10-year. If we don't, then it's going to be a pullback probably worthy of buying. We'll talk about that when we get there, but for now, what is the strategy? On Friday on Discord, I said the VIX finished its downside target, so we have a new low in the VIX, by the way, and the market failed to make higher highs because yields are beginning to reverse. Likewise, it looks that the DIX is maintaining its lows and beginning to move higher. So my strategy for next week, we have to flip to, let's say, 2-to-1 or 3-to-1 downside exposure versus upside. And what I'm going to do is keeping the Apple puts that we got, the 190, 185, expiration date December 1st. You can roll to December 8th, but I would wait for a confirmation before I do that on Monday. That contract's still good and will give you coverage against the big caps. And I said since the SMH is showing a topping pattern, and this is what we're talking about. If we look at the weekly chart for the SMH, we have a bump against the upper Bollinger Bands. You can pass on that in the daily chart, but on the weekly it becomes a really, really strong signal that you're going to slow down from here. It's also a reversal candle. Assume it plays out, let's go with the SOXS calls with the expiration date of December 15th at the strike price of $9, which costs, by the way, 35 cents a piece. Not bad for some downside exposure in the market here when it comes to chips. Likewise, if we're going to see a rebound in bond yields, some of the most sensitive names to bond yields are the stocks of marketplaces. So we talked about high flyers such as Moody, MCO, showing reversal signs. So we also bought at the money puts, December 15th expiration. If you look at the chart of Moody, MCO daily chart, we got a reversal candle, shooting star, then followed by confirmation. RSI is really way too high. You look at the weekly chart, we're again at the target here of the upper Bollinger Bands. Other similar stocks such as SPGI, S&P Global, could be a similar play, but did not give us a strong signal as we've seen in Moody. But they're all going to work the same way, even CME. So you got to shop around and pick the one that works for you. 4. We're going to keep one upside exposure here in the IWM small caps 180 calls, expiration date this week, December 1st. If we drop down on Monday, boom, take it off the table because we have an inclusive correction here. We're going to stick with the downside exposure. And of course, we'll update you on the strategy on Discord. So if you're not with us, if you're not a Maverick member, consider joining. But let's expand the conversation here, folks, and talk about how the market performed last Friday. Look at the charts, look at the options, look at the heat map, futures. But before we do that, let's see how the market closed on Friday, and here we go. The diamonds closing positive by 117.12 points, or a gain of 0.33%. Nasdaq in the red, down by 15 points, or a loss of 0.11%. Spider positive, be it flattish, with 2.72 points, or a gain of 0.06%. Russell 2000 was the outperformer, up by 1.36 points, or a gain of 0.76%. If we look at the sectors on Friday, again, not a risk-on theme, it's more of a risk-off theme / maybe buy some exposure to energy, some short covering in energy because of this OPEC meeting. So we see healthcare at number 1, we see energy at number 2, industrials, real estate at number 3 and number 4, the laggards, the risk-on, comm services, and technology. You contrast this with the weekly performance of the market here. Once again, a similar theme. All sectors are positive, but the laggards, a combination of risk-off utilities, but maybe that is in anticipation of the rebound of bond yields. Then we have the risk-on in technology and comm services, also lagging. Energy, the inflationary trade is leading. The recession trade of healthcare is also at number 2. Then we see cyclicals at number 3 because of some earnings, big earnings that came out this week. If we look at the breadth all in all on Friday, pretty good. Low volume, path of least resistance is higher. So we see the NYSE 75% advancing versus 22% declining. The Nasdaq 70% advancing versus 26% declining. So the anticipation here is that we have to go back to neutral, and the breadth will get a little worse here as we go back to the 50-50 line or closer to that range. Moving on to commodities, here's how we closed on Friday. We got more declines here in crude, WTI, Brent. WTI went down by more than 2.5%. Brent went down by almost 1.5%. So Brent is outperforming because the impact of OPEC Plus will come in the Brent, not WTI, although WTI will also follow if there is a short squeeze in Brent, be it at a smaller gain. RBOB was down by a little over 3%, good for the consumer, but because of a recessionary reason. Then we have diesel down about 2.25%. Again, due to the recession, although natural gas, the seasonality, the dips are being bought here in natural gas, so we see gains worth about 3.5%. And folks, when we talk about energy commodities, believe it or not, the best performing energy commodity is actually uranium. We talked about the demand for uranium as we see countries maybe warming up back to nuclear energy as we see the transition to green energy, maybe in the time being right now. Nuclear energy is not really that bad of a choice. So we see uranium prices shooting up to the sky here. You see stocks such as Cameco, for example, doing pretty good. But I'd watch uranium prices here because as we head to the next contract, some folks will begin to book profits. As uranium prices dip, we will see these stocks such as Cameco pulling back, but that could be a buying opportunity if we see rebounds in the future price here. When we talk about softs, no meaningful moves here. We have OJ down about 1.5%, but again, off massive gains, so just a little bump here. Coffee down marginally, and then we have sugar down a little over 1.25%. And the outperformer, lumber futures, up by about 1%. And we talked about the correlation between lumber and the stock market. When lumber futures move higher, we usually see the stock market also moving higher, a leading indicator. So when we see lumber futures pulling back, it will probably be a good sign that stock market will also pull back. When we look at metals, we see that the defensive metals, gold and silver, did pretty good, specifically silver, gains of about 3%. Problem is, if the dollar rebounds, we know that gold and silver are bullish. And the reason is we have the geopolitics risk, we have the recession risk. But if the dollar pops big time, we're going to probably see a profit-taking move in gold and silver, which will probably be an opportunity to buy. So if you want to chase here, be careful, you might get a better buying opportunity. The risk on metals, platinum, palladium, copper, did pretty good on Friday, but the dollar rebounds. If we begin talking about stagflation, they're not going to do pretty good, and we have let's say a bad sign for copper futures, because right now copper prices at the biggest contango gap that we have ever seen, which means that future prices for copper will probably be down. Why would they be down? How about a recession? Copper is the leading metal to that. We'll look at meats and grain futures. They're all down for the most part. We have exceptions in rough rice and oats, both in the green on Friday's session. Moving on to the big casino, the options market, what do we see here? Volume was down on Friday, got it, so we see the volume down across the board, but the buy is still in buying calls versus puts. And I would say that the spread is getting a little too excessive here. We see high 50s, we see 60s, even 70s. That's not going to last for now. So we're going to see some of this chasing of call options under a squeeze and low volume as we've seen in the last couple of weeks. But it's probably a sign that things are going to reverse here because you're going to see a lot of calls in the money, threatening to be in the money. Market maker will do the opposite move to make sure that these calls will expire worthless. And with the VIX at lows of the year, puts are cheaper. We're going to see a movement to buying puts and hedges right now. So as we head to this new week, my expectations are things are going to begin to flip. But for now, let's move on and do the unusual activities that took place in the options market on Friday. We begin with the ticker BMBL, for Bumble. Somebody sees a big drop coming north of at least 15% by the expiration date of January 5th. Therefore, they bought the $12 puts for the expiration date, January 5th, cost them about 20 cents a piece, spending about $400,000 for this trade. So if you want to short something, maybe Bumble, look into it here. Somebody sees a fundamental catalyst coming. Then we have BABA, Alibaba. Lots of optimism as we headed into earnings. The chart beginning to look a little better, but of course we got a disappointing report. And now with the rebound of the dollar, we're probably going to see Chinese names pulling back. So somebody bought puts here on BABA at the 71 strike. Expiration date, January 5th. Expectations, the stock will go down and lose more than 9.5% of its value by then. Paid about 80 cents a piece to enter this trade, all in all, spending about $350,000. And then we have COIN Coinbase. Now, as crypto prices went higher, we saw Coinbase as a high flyer in the last couple of weeks, but somebody's saying, okay, time for a pullback here. It could be a little severe because they bought the 102 puts, expiration date, December 8th. Expectations, Coinbase will go down and lose more than 12% of its value by then. Paid about $1 a piece to enter this trade, all in all spending about $350,000. Then we have a trade for the ticker CAT Caterpillar. You know, when the economy is good, you want to buy Caterpillar. When it's not good, when we're heading into a recession, you want to short Caterpillar. Maybe somebody sees something bad going on here and they bought the 230 puts for the expiration date, December 22nd. Expectations, Caterpillar will go down and lose more than 7% of its value by then. Paid about $1 a piece to enter this trade, all in all spending about $250,000. Last but not least, here's the big boy, NVDA. And somebody's betting for more downside to come. They bought the 430 puts, expiration date December 29th. Expectations, the name will go down by more than 10% by then. Paid about $4 a piece to enter this trade, all in all spending about $1 million. On to the heat map for Friday. What do we see here? Of course, we see some money coming out of the big caps. Meta, Google, Apple, Microsoft, NVIDIA, Amazon, all underperforming for the day. Tesla moving a little higher, but Tesla is the laggard, so it is in the catch-up trade, not in the chase trade. So we see the catch-up trade outperforming the chase trade, exception, of course, the Ozempic, Mania, Eli Lilly, and NVO. Of course, the volume was low, so the path of least resistance for the rest of the market was higher. But it is really interesting that we see bond yields rebounding and we see money coming out of the big caps, profit taking from the big caps. Leading indicator, I think so. But if we contrast the picture for the week, not really that different. We talked about in the long side, you want to be in the catch-up trade, not in the chase trade. But we see that the laggards this week are the big caps. The poster boys for the chase trade, Meta, Google, Apple, Microsoft, NVIDIA was negative. Amazon was the exception. But we see the best of outperformers coming out of other sectors. If we look at healthcare, for example, we talked about Medtronic, MDT, but also Thermo Fisher, TMO, Donner, DHR, nice rebounds here. If you look at financials, we have Black Friday. Folks are going to spend either way, whether they're weak or not, because they've been saving for it. So we're going to see MasterCard, Visa, big outperformers this week. Rebound in energy, we talked about that. In industrials, you have BA Boeing. It was an opportunity to buy once it dipped down and got sold off in an aggressive way. Now I think Boeing probably is going to pull back and maybe give you an opportunity to buy here because recession or no recession, Boeing has really big contracts by the Emirates, by Riyadh Air, by China Air. That's not going to change, folks. And then another notable decliner is SBUX Starbucks. We have seen an unusual options trade on Starbucks, shorting the name, did play out, and the name went down by a little more than 4% this week. Let's look at the heat map for the ETFs. Weekly heat map, what do we see here? Once again, the catch-up trade outperforming. Since we have no major move in the bond market, TLT, or the dollar, so we saw the IWM outperforming large cap growth. We've seen some of the catch-up trades, such as the XBI Biotech, outperforming chips and technology. And of course, a hot trade within the catch-up trade because the dollar been going down is the GDX Gold Miners, NUGT, if you want to be a little more aggressive here, GLD, the actual commodity, SLV Silver. But watch out here. Once we get a rebound in the dollar, I would probably say that gold miners and silver, gold for that matter, will pull back. It will probably give you a better buying opportunity. So watch for that. Another ETF that I don't like and probably will fade the rip in is the XRT. Folks buy it by default because they think that Thanksgiving will be good or holiday season folks are going to spend, yada, yada, yada. But we always see sell the news once the good news comes out. Oh, Black Friday smashed whatever. XRT actually goes down after that. And we have seen a lot of warning signs from these retail companies. So I'd be looking to fade the XRT here. Anyhow, let's do some charts and then wrap it up. We begin with the SPY, the S&P 500, and we'll do a daily chart this time around. If we look at the daily chart, we have finished the last gap above to the penny pretty much. Put in a doji candle. And on Friday, of course, there was no volume, so we closed flattish. The risk to the upside, if we go all the way to the previous top from July at 459.44. But as you can see, the risk to the upside is limited. The risk to the downside is plenty. Why? Because we have plenty of gaps below that are unfilled right now. If we use Fibonacci retracement, suppose we get a top right here, assuming that this is the top of the reband, and down we go from this point on. The first retracement will be in or around 445. That will be a downside of about, let's say, 2%, which is a garden variety, really. After a massive move like this, you need a 2% pullback. That's normal. That's nothing to panic about. If we go down below that, then we can talk about it when we get there. But for now, we're just looking for the pullback because the hour size is getting really overbought. MACD is stopping off. So if this is indeed the top of the move, then 450, 445 will be a good target here, at least for the first pullback. And then we'll take it from there. If we look at the SPX, the cash index weekly chart, what do we see here? We know that 4,600 becomes the target here, at least from a psychological level. And it could be the risk to the upside. That whatever pullbacks we get, dip buyers show up and then they get us to 4,600 again. We're not at the top of the Bollinger Bands yet. So the SPX right now, not showing us a clear sign that this could be the top right here of this move. The risk, of course, if you happen to be bullish is, if you squeeze a little more and you get to 4,600 right away, the risk could be a double top and then we go down from that point on and not challenge that 4,600 number again. What you want to see instead, a pullback, retest the 20 weeks moving average in or around, let's say, 4,400, and then rebound and form an ABC pattern and crack above 4,600 once and for all. The reason is if we pull back and the buyers show up, it's a good sign that folks want to buy here legitimately. And with fresh energy showing up in the move, it will make it higher. But if we pull back right now and we don't see any buyers, even if we make 4,600 and then pull back, and if the buyers don't show up, that will be a warning sign that this was a dead cat bounce all along. So we'd like to see how the reaction would be at the first real pullback here. If we look at the daily chart for the E-mini futures, what do we see here? Of course, the bulls would say that this is a bull flag formation here above 45, 44.75, nothing to worry about. The bears would say, watch out, the hour size stopping, the MACD is losing momentum. The volume is really low, so the moment we get some volume, it's going to be to the downside. And the risk, of course, the bears are going to be right if we lose 45, 44.75. Better yet, we go down to 45.09 because that's going to erase the bull flag pattern. But even if we get there, no harm done for this move. The harm begins once we lose 44.72, better yet 44.45. So this move has a lot of cushion here. And this is why you got to be careful being too aggressive on the downside. You got to stick closer to the money if you're trading options. If you're hedging, the same thing. We have to take it one step at a time, folks. If we look at the Qs and hourly chart, what do we see here? We got a bear flag pattern followed by yet another bear flag pattern, but no confirmation yet until we lose 388. If we do that, then we can talk about, okay, we got a top here and down we go, because you look at the daily chart, we have a reversal pattern, but without confirmation yet. We know that the hour size overbought, MACD is weakening, yada, yada, yada. So suppose this is the top when we pull back from here. We use Fibonacci's help. We got 381 as the next target. That will be a decline of about 2% or so, which is a garden variety pullback after a massive move like this. If we look at the weekly chart though, what is the upside risk? 398 in or around that number. Honestly, it becomes 400 just from a psychological / a call option positions. It's easier to buy 400 versus 398. The downside risk though is, well, we're putting a topping candle here. We're getting to the top of the weekly Bollinger Bands. Usually that holds and produces a pullback. Who's to say we're not going to pull back to the 20 weeks moving average? When we see the Bollinger Bands expanding out of contraction, as we've seen in the beginning of the year, and we get to the top of the Bollinger Bands, usually we get the pullback, as you can see here, and a retest of the 20 weeks moving average. And that will be in or around 369. So that's the longer term pullback target. If, let's say, the first Fibonacci in the daily chart doesn't hold, then we can talk about this. And last time around, once again, the pullback was worth about top to bottom, about 9%. So it's not a surprise that we see a big pullback after a big move like this, but usually it happens incrementally, not in one shot, not in 1 week. It could happen in 1 week, but again, to be conservative, you got to go with the daily chart pullback target first, and then if that's broken, then we can talk about the weekly chart. You look at the daily chart for NASDAQ futures, what do we see here? Topping signals on the RSI, on the MACD, and the Vortex indicators. They're all topping and moving down now. We see the chart now losing 15,975, so we're losing one support line. No biggie. If we go down to 15,700, that will be a garden variety pullback. If we go down to 15,500, that will be also okay. If we lose that, then we got a problem here, folks. But we'll take it one step at a time here. We have a topping pattern. Let's see how it reacts at around 15,700, then we'll take it from there. If you look at the small caps IWM daily chart, the reason why we're keeping the upside exposure in the IWM is because we have a bullish pattern. And it's not really that overbought as we see in the SPY and the Qs. What bullish pattern we're talking about? The break outside of the triangular consolidation pattern. The problem is, though, if we look at the weekly chart, we're not above the 20 weeks moving average. We closed at the higher high, good sign, but who's to say that we're going to make it above the 20 weeks moving average? If we have a rejection from here, forget about it. We're probably going to go back to the lows in the IWM. Confirmation to buy more or go long altogether. In the IWM, you're going to see a crack and a close above the 20 weeks moving average, which is right now sitting at around 181. Dollar daily chart, what do we see here? We talked about 103.458 basis points as strong support for now. And it's holding. If it holds and we see a bottoming pattern and a rebound in the dollar, you got to remember that the drop in the dollar caused the market rally and short covering. So a rebound in the dollar will cause the opposite, that we're going to see profit taking in the market and we see a pullback. For now, the assumption is pullback. Now, if the dollar makes it above the 20 days moving average, then we got a problem. But we'll talk about that if we get there. How about the old man gold? Daily chart, what do we see here? We made an official higher high. Good news. Bad news is if the dollar pops and rebounds, you probably see a pullback here in gold. So you want to hold your horses a little bit here and see how the dollar reacts first. Although in the weekly chart, any pullback is viable, at least for now. And the reason is the risk, at least for now, is for an ABC pattern. The bearish risk could be for a double top, but we're not there yet. I think the higher risk is for an ABC pattern and challenging the highs. We look at SLV silver. Again, the daily chart keeps getting outside of the Bollinger Bands and it keeps getting pulled back by the technicals. What does that say? It says that the chart is really hot. So we have incredible strength here. We have incredible demand for the SLV. Problem is it keeps defying the technicals and it's going to be pulled back. So you're better off waiting for this chart to cool off a little bit, and then the recent strength will show up again, and we will see it going higher, assuming the dollar just rebounds then pulls back again. How about Brent oil, UK oil daily chart? What do we see here? Let's start with the bad news. We're below the 20 days moving average. Not good. We're also now trading below the top of the breakdown candle. Not good. What's good though? How about a pattern of a bull flag? That whatever comes out of this OPEC meeting could push us higher. And of course the confirmation will be closing above the 20 days moving average. Reclaiming 85 will be even a better signal here that oil is back on track again. If we look at the XLE oil stocks daily chart, we closed above the 20 days moving average. So for now we have a positive sign that we could see oil stocks recovering here. And of course if oil rebounds, that'll be a problem for equities. If it's combined with the dollar rebounding higher, even more trouble, and of course, the ultimate trouble will be coming from the bond market. If bond yields also rebound, we're already seeing that, folks. The 2-year yield, which the Fed holds right now and controls right now, that's moving higher out of a double bottom. Mr. Powell is going to speak this week, and I think he's going to clarify, folks. You're getting too excited here. Sure, we might have paused right now, but the risk is still to the upside for inflation. So hold your horses and tame the excitement when it comes to rate cuts, because we're probably not going to do that until it becomes really, really bad. He's not going to say that, of course, but he's going to hint that we're not thinking about cuts right now. In fact, cuts will only happen for the wrong reasons. That will be the implication. He's not going to say it, but that's what we're going to get out of it. So now we see the 2-year yield moving higher again. The 10-year, the most important one. We talked about the wedge pattern. We got the breakout. We have a saucer bottoming pattern now. You look at the MACD, you look at the RSI, the Vortex indicator. Positive momentum is coming. And as Art Cashin said, it's okay until we get to 4.55. My number is 4.56. Then we got a problem. I would be even more conservative here and say 4.657 basis point. If we get a rebound in the 10-year all the way to that number, then that resistance hold holds and we pull back from that point, then okay, so far so good. We got a pullback in the equities market. The pullback is buyable. If we begin to trade above 4.657 basis points here, then we're going to risk 5% again. Equities market will flush down. How about the VIX, the volatility index, daily chart? What do we see here? We talked about the risk of going back to the lows. Well, we did that and then some. Implications. We were afraid that if the VIX goes down to the lows, maybe we'll see the SPY going higher. And we were looking for hedges and we went with the IWM. Some went with SPY calls for the week. Got it. But the problem is, it never played out. The SPY did not really make a higher high, even though the VIX went to a lower low. What is the problem here? It says that the SPY is being held from making higher highs because the dollar and bond yields are moving higher. So even though puts are getting out of the picture, crushing the VIX, it's not exciting the equities market to go higher. In other words, we could see other folks who are looking at the VIX right now say, wait a minute here, puts for the SPY are the cheapest this year so far. After a big move like this in a short amount of time, sure, I'd like to have some hedges, I'd like to buy some cheap puts here, and that causes the pullback in the equities market, along with the algorithmic reaction from the rebound of the dollar and bond yields. Big Kahuna Apple, hourly chart, what do we see here? Lost the gap, forming a bear flag pattern right now. Confirmation if we lose 188.57. And then we have the gap support number 1, gap support number 2. And by the way, we produced an options tutorial video for the members today discussing the trade for Apple. I highly recommend that you watch that video. We got good marks from the viewers saying that it was really helpful in understanding how to trade options properly. Anyhow, in the daily chart, if we look at Apple here, we have a topping pattern followed by confirmation on Friday. And if we use Fibonacci, assuming that this is the top indeed, we go bottom to top. Next support will be in or around 186.5. That will be a pullback worth about 2%. And that aligns with SPY and the Qs. If we look at the weekly chart for Apple, what do we see here? Topping pattern, sure. Pullback would be in or around 182.34, in or around the top of a really important candle from the month of September. And also would coincide, I think, at the time with the 20 weeks moving average. So that would be my maximum pullback target here. If we break the support, then we can talk about, okay, this was a fake rebound and we're going to make lower lows, but we're not there yet. How about Tesla, Souffle, daily chart? What do we see here? Outperforming because this is the laggard, the catch-up trade, not the chase. The RSI is not overbought. So this theoretically has the room to pop higher better than any other stock in the Max 7. The problem is we have no confirmation yet. If we get a break above 242, sure, we have to go with the 250 calls. If we break 230.61 on the other hand, there is a high possibility that that could be the case. Then we have to go with the puts. And my target would be in or around 220. We'll talk about these trades on Discord, and then we have, lastly, tulips, Bitcoin, daily chart. What do we see here? Momentum is really, really strong. Even though we got a false signal, the bear flag played out, gave us a false signal when Bitcoin went below the 20 days moving average because it got corrected really quickly here. That is an indicator that we have hot demand for Bitcoin. And now we're probably forming a bull flag pattern in or around 38,000. The problem with Bitcoin here is it didn't really give any traders or buyers a good opportunity for pullback, a decent pullback opportunity, which makes it a little toppy here. Sure, the momentum can get hotter. We see a chase trade and Bitcoin explodes higher. Look at the weekly chart here. We're forming a bull flag. We're flirting with the upper boundaries of the Bollinger Bands in the weekly chart, which is strong technical resistance. The RSI is really overbought, but we have no signal yet that the technical resistance is now beating the excitement of demand. So what do you do here if you're a trader and you're not really in Bitcoin to begin with? I would say the discipline says you got to wait for a pullback. But on the other hand, what if this is an explosive move to come? It got ample opportunities to pull back. It didn't do so. And the demand is really high. So if you have FOMO, you hop in. But you got to be aware of the risk here, that you're going against a lot of technical boundaries. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar this week? We begin with Monday, November 27. Not a lot. We have new home sales. That will be important for certain stocks, home builders, etc. Then we have Tuesday, November 28. We have the Case-Shiller Home Price Index, lagging indicator for inflation. We have consumer confidence. Then we have a bunch of Fed zombies speaking from Christopher Waller, Chicago Austin Goolsbee, Governor Michael Barr, Governor Michelle Bowman, all speaking Tuesday. Wednesday, we have the GDP, the first revision. If it's a big one, could be a market mover, but we're not going to bet on that. Then we have advanced U.S. trade balance in goods. That will be important. Then we have President Mister from Cleveland. She's waving goodbye, so whatever she says is not going to matter. And then we got the Fed Beige Book, important indicator whether we have a recession or whether we have a risk for more inflation. Inflation expectations were certainly shocking according to the data that we got this week. You'd think that inflation expectations will go down in the long run. And then Thursday, November 30, we have initial jobless claims. This becomes really important every week as we talk about recession risk, but we also have the inflation risk from the PCE inflation index. And after that, for commentary, we have President from New York, John Williams, and we also got the Chicago Business Barometer and pending home sales. Friday, the 1st of December, we got a bunch of Fed zombies speaking, but most importantly, the big dog, Jerome Powell. All eyes will be on Mr. Powell. Then we have ISM manufacturing, construction spending. This will be really important because construction has been holding the economy here. If that begins to fall, we got a problem, folks. We might also get auto sales, so that's going to be important for inflation and the health of the economy, consumer demand, etc. But folks, perhaps the most important events we're getting this week, forget about Powell, forget about the macro, will be from the bond market. So we have a bunch of auctions here. We know that from a technical standpoint, bond yields are due for a rebound. What if the rebound is amplified by one of these auctions bombing? Then we're going to go back to 3 weeks ago, last month, when we were talking about the risk of supply and bond yields going higher again. And that's going to be a problem for the equities market. So once again, all eyes on the bond market. With that, folks, hope you enjoyed the show and found it informative. If you did, press the like button, subscribe, give us a nice comment, and consider joining us as a member. But this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
I need to know how Skynet gets built. Who's responsible?
The man most directly responsible is Sam Altman.